We are absolutely in an AI bubble now. It is going to burst. I don't know when.
Are we in an AI bubble? Of course we are.
It's the talking point causing concern on markets around the world.
Stock market bubble is when lots of money is chasing a certain group of assets. This time it's artificial intelligence companies. And the value of those assets, the value of those companies, has got ahead of what the fundamental value of them might be.
Shares in the big tech companies driving the artificial intelligence revolution have soared as investors desperately seek a piece of the action.
Look, I don't think you can deny that irrational exuberance is definitely back in the market when it comes to AI and tech stocks.
They do look pretty frothy.
The amount of money we're talking about is huge. Tech companies now account for just under a third of the entire value of the main S&P 500 share market index on the New York Stock Exchange. They've been the key factor pushing Wall Street to record highs this year.
And it's not unusual for investors to get very, very excited when new technology emerges that is widely believed to change the course of human history.
There's one company above all others driving the market further. The share price for Nvidia, which makes chips and electronic circuits, has jumped by more than 30% this year. More than that, it's grown more than 1,000% since the beginning of 2023. And in October this year, Nvidia became the world's first company to hit $5 trillion in value.
It's that old adage of, in a gold rush, you want to be selling the picks and the shovels. Nvidia is the picks and the shovels.
Even key players in the AI industry acknowledge things are getting a bit exuberant. OpenAI boss Sam Altman says investors are getting overexcited about AI. Altman is also sensitive to questions about OpenAI's numbers.
How can a company with $13 billion in revenues make $1.4 trillion of spend commitments? You know, and you've heard the criticism,
First
Sam.
of all, we're doing well more revenue than that. Second of all, Brad, if you want to sell your shares, I'll find you a buyer. Enough.
Those worried about the AI boom exploding point to the staggering amounts of money being spent on building data centres to house the computer servers that store and process digital services. Hundreds are popping up around Australia.
It's been predicted that over the next few years, more than $5 trillion is going to go into AI and data centres and things like that. Now, to put that in perspective, the Apollo program cost $300 billion in today's money. So we're talking about 17 Apollo programs.
And the companies building all this AI infrastructure, otherwise known as tech hyperscalers, are going to have to make massive amounts of money to break even.
Every iPhone user in the world, of which there are about 1.6 billion, will need to spend roughly $35 a month on AI tools to give these hyperscalers a return that covers just their cost of capital. And that's an extraordinary assumption to make.
Worries have extended well beyond the markets. The OECD is warning of the risks to the broader US economy of overvalued tech stocks.
The fact that we're talking about a bubble, but still investing in that bubble, is very curious, and sooner or later somebody is going to stop passing the parcel. The music will stop, and it could get quite ugly, unfortunately.
Comparisons are being drawn to the dot-com bubble at the turn of the century.
Now, while most of the big tech stock action is happening nearly 20,000 kilometres away on Wall Street, a lot of Australians do have skin in this game, whether they like it or not. Australian superannuation funds have roughly $600 billion of their members' money invested in the US. A significant proportion of this cash is exposed to those tech stocks. And the amount of super money pouring into the US is expected to top $2 trillion by 2035.
Australian savers are more exposed to share markets than we've ever been in history.
James Thompson writes the influential Chanticleer column in the Australian Financial Review. He believes a popping of the AI bubble will be felt keenly.
Obviously, value of people's portfolios will go down, but that can have a reverse wealth effect. You know, people feel like their super's not doing as well. oh, we better rein in our spending a bit, and then you see the economy slow down. So I think that's the danger to watch out for.
Well, there's certainly been some exuberance, and it's for us to now look at that as investors to see if that's actually irrational.
Alex Joyner is the chief economist at IFM Investors, a group that invests on behalf of Australia's biggest industry super funds. He says the funds have outgrown the Australian market and need to be where the tech stock action is.
And if you want exposure to that, and that's desirable because it's been really beneficial for superannuation members' returns, then you need to be in the US market.
For all this concern and worry about the AI boom, the technological advancements and resulting economic benefits could change our lives forever.
What will be laid for future generations by the investment today is going to be profoundly game-changing for our economies and our lifestyles, workforce, everything.